Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and we're halfway through reporting season with a lot of the retailers already out there reporting their results. We've seen some pretty big share price moves. You've got JB Hi-Fi, Nick Scali and Super Retail all performing well on the back of their results. And on the flip side of that, Adairs and Myer seeing their share prices hammered. Gaston, what's been happening out there and what we've seen so far?
Well, it's a lot of volatility and a lot of confusion, I think.
We're confused or the market's confused?
I think everyone's a little bit unclear as to exactly what's happening and what the market is pricing in. So I think starting with the good, if you take something like Nick Scali, they reported an FY23 which was, I think it was okay, it was in line, it was a strong finish for a difficult year, but when you actually go one layer deeper, when you look at, so sales were up 15% year on year, but that's because you had 8 more months of plush inclusion. When you actually start digging into the written orders, they were down 8% year on year for the full year, and if you look at the second half, they were down 16% year on year. These are like the written orders when you go and buy a sofa. So that's clearly, so the backlog of orders has diminished. That's clearly not a great leading indicator. And if you look at the comps, we probably have like between 6 and 12 more months of difficult compares year on year. Now the stock is up 50%, as you said, and we're wondering why. Possibly because it's a good business, incredibly well run for the short term and the long term by Anthony Scali, and I guess people just want to get behind these businesses when they can.
Yeah, I think at JB Hi-Fi, they're talking a lot about the cost inflation that's still to come through over the next year as well. So even they, who are reporting some pretty, I'd say, resilient sales numbers is maybe the right word for it in what's a very difficult environment, particularly in the core JB Hi-Fi brand, but saying they've got wage inflation of 5-point-something% coming through, rents going up. You should probably still expect to see those margins retract there in the next 12 months or so.
Yeah, and I think Adairs was a very good example of that. I mean, Adairs is a stock that, again, it traded up from June into results like with the rest of the sector, and then they deliver results, and the stock is back to where it was in June from 140 to 180, I think, and back to 140, and precisely because of that margin crunch that you're talking about, utilities up, wages up, rent up, and sales that are for what is a very mature business and somewhat cyclical or quite cyclical things that you're selling. So that's at the other end of the spectrum.
Yeah. We talked about this sector at our roadshow as a sector that we were hoping to get some great opportunities over the course of the next 12 months. Amongst a few others, a fair bit of pessimism out there about it at the time. We've dipped a toe in the water. We'll talk about it in the coming monthly report. We're doing a little bit of Lovisa, but it's not a significant investment for us in the sector still. Have we missed our chance here with these share prices running hard?
That's a $1 million question. Look, it's unclear. I still have a lot of doubts, particularly as we highlighted in the roadshow. You have 50% of the mortgage or the fixed mortgage book that is coming up for refinancing in this half, in between June and December. That's a lot of mortgages that are going to reprice from 2% to 6-7% if you decide to fix or thereabouts. So that's a wall of money that has to be redirected from other users into paying back the bank. That cannot help a discretionary category like these retailers.
Yeah, so I mean, there's more pain to come. That doesn't always mean share prices have further to fall. I think a lot of people make the mistake of thinking that as the worst possible results are coming out, the share price is also going to be at its low. And we've seen in some other sectors the share price will recover well before the business starts to recover as people start looking forward into the future. And James Hardie is one that you've done a lot of work on over the past 12 months, and we really wanted to add that to the portfolio, and it's run away on us as well.
Yeah, that's a very good example. So I think towards the end of 2022, we did a lot of work on James Hardie, and you could see how it was going to be a difficult cycle for the US, particularly on the repair and renovation side, with people locked up in their homes, but not doing big renos because they're not buying and selling houses. They're just staying where they are, and yet the the market didn't care. The stock is up 50%.
Yep, and that's well and truly possible here as well. I'll personally be surprised if we don't see more distress in this retail sector, but if we don't, we don't. Errors of omission are far less important than errors of commission, and I think it's a good sign you're looking in the right place, looking at the right sectors if share prices do well from that point in time, even if you don't own it. And we're still hopeful and confident that there will be opportunities crop up in this sector over the next 12 or 18 months. But for the moment, the stock market in general is being pretty optimistic, particularly about the better quality businesses. I think there's a small number of companies that everyone wants to own, and they're taking any sign of positivity that they can to buy those stocks. I hope you've enjoyed today's video. Send us any questions you would like answered, and thanks for tuning in.